December 29th, 2025, 11:42 p.m. Eastern. This is not a prediction. This is a warning. And if you're watching this in the final days of 2025, understand something very clearly. 2026 is not just another year. It is the year consequences arrive. Because the system that has held together global finance for decades is cracking, and silver is about to expose it. Tonight, we are going to explain why some analysts believe silver reaches $150 per ounce by the end of 2026, why that number may actually be conservative, and why the window to position is closing faster than most people realize. This is not hype. This is math. Part 1. The shocking number. No one is talking about. Let's start with a number that should stop you cold. $30 trillion. That's the official U.S. national debt. Now here's the part most people don't think about. At current interest rates, interest alone will soon exceed military spending, social programs, even infrastructure. The system is no longer servicing debt. It is compounding failure. And here's the question. No one on mainstream television wants to answer. How do you pay debt that cannot mathematically be repaid? You don't. You inflate it away. Part 2. The death of the dollar. By design, not accident. This isn't political, it's arithmetic. The Federal Reserve has two options. Allow rates to stay high and trigger mass defaults, print currency at scale, and destroy purchasing power. There is no third door. Every historical fiat system ends the same way. Not with collapse first, but with debasement. Currency dies quietly and then suddenly. And when trust in paper breaks, capital does not flee evenly. It runs toward scarcity. That's where silver enters the frame. Part 3. Why silver, not gold, is the fuse. Gold protects wealth. Silver exposes systems. Why? Because silver is both. A monetary metal, a critical industrial input. Gold can be hoarded, silver gets consumed. And in 2026, that consumption hits a wall. Part 4. The 2026 industrial cliff. Here's the part Wall Street is still modeling incorrectly. By conservative estimates, industrial demand alone will approach, or exceed, 100% of global silver mine supply in 2026. Let that sink in. Solar, EVs, AI data centers, semiconductors, defense systems, medical devices. These industries do not reduce demand when price rises. They bid higher. Because shutting down a $1 billion production line costs more than paying $100, $150 silver. This is what economists call inelastic demand. And in commodities, inelastic demand during a shortage is lethal to price stability. Part 5. Supply. The invisible collapse. Now let's talk about supply. No major silver discoveries in over a decade, falling ore grades, environmental restrictions, 10 years to permit and build a new mine. And here's the fatal detail most investors miss. Over 70% of silver is a byproduct. That means higher silver prices do not automatically increase production. If zinc and lead mining slows, silver supply shrinks. Even if price rises, there is no surge capacity. The buffer is gone. Above-ground inventories have already been drained quietly, year after year, deficit after deficit. 2026 is when the market realizes there is nothing left to draw from. Part 6. Paper silver, the fractional lie. Now we get to the part that makes people uncomfortable. The COMEX, LBMA, unallocated accounts, ETFs. For every physical ounce of silver, there are dozens, possibly hundreds, of paper claims. This system only works because most people never demand delivery. Trust remains intact. The illusion of abundance holds. But here's the problem. Trust breaks suddenly. And when it does, paper silver doesn't reprice. It fails. Part 7. Force majeure. The word no one wants to say. When physical silver cannot be delivered, exchanges have one option. Cash settlement. That's called force majeure. It's legal, it's contractual, and it's catastrophic for confidence because once that happens, silver becomes a two-tier market. Paper silver, cheap, meaningless. Physical silver, scarce, priceless. At that point, price is no longer discovered. It is rationed. Part 8. $150 silver. Why this is not extreme. Oh, we'll see. Let's address the number directly. $150 per ounce by the end of 2026. Sounds extreme? Consider this. 1980 inflation-adjusted high, over $600. Gold at 4,000 plus Rs implies silver north of $130 at historic ratios. Industrial buyers alone can support triple-digit pricing. Monetary demand hasn't even entered yet. $150 is not euphoric. It's orderly repricing in a broken system. The real danger is not how high silver goes, it's how fast. Part 9. BRICS, de-dollarization, and the commodity shift. Now layer in geopolitics, BRICS, bilateral trade agreements, gold accumulation, commodity-backed settlement systems. Whether a formal BRICS currency launches in 2026 or not is almost irrelevant. What matters is this: the dollar's monopoly is ending. When dollars flow home, they don't disappear. They inflate domestic prices. That's when silver remonetizes, not by law, but by necessity. Part 10, the psychology. How mania actually begins. Manias don't start with retail buyers. They start with industrial panic buying, sovereign accumulation, institutional repositioning. The public arrives last. By the time silver breaks $50 convincingly, by the time headlines turn bullish, physical supply will already be gone. This is a tiny market. When capital floods in, price doesn't climb. It jumps. Part 11, price targets. Scenarios, not promises. Let's frame this correctly, not predictions. Scenarios. Base case, $100, $150. Industrial demand absorbs mine supply. Monetary debasement accelerates. Paper market stress increases. Upside case, 300 plus. Delivery failures. Forced cash settlement. Public FOMO enters historical context. Case, 600 plus. Inflation adjusted mean reversion. Silver resumes monetary role. The number matters less than the mechanism. Shortages do not resolve gently. They end when price destroys demand. Part 12. Risks. Let's be honest. Let's be clear about something up front. This will not be smooth. Markets under stress never are. Anyone promising a straight line higher does not understand how fragile systems behave when they are pressured. There will be violent pullbacks. There will be sudden sell-offs that seem to come from nowhere. There will be sharp, engineered price smashes designed to do one thing, and one thing only: break conviction. Paper markets do not surrender quietly. They defend themselves. They exhaust longs. They trigger stops. They weaponize volatility. Not because the thesis is wrong, but because the system itself is under strain. And here's the critical distinction most investors miss. Volatility is not weakness. Volatility is stress revealing itself. It's pressure escaping through price. And when volatility increases while fundamentals tighten, it's not a warning sign, it's a confirmation. Stress is rising, and stressed systems do not glide back to equilibrium. They fracture. Part 13. What this means for you. This is not a call to day trade. It's not about catching every move. It's not about timing the exact top or bottom. It's about exposure. What you own and how you own it matters more than ever. Physical silver removes counterparty risk entirely. No intermediary, no settlement promise, no clearinghouse dependency. You either hold it or you don't. Primary silver miners offer leverage. When silver rises, margins expand rapidly. But that leverage comes with volatility, dilution risk, and operational exposure. Paper instruments, ETFs, futures, unallocated accounts depend on trust. Trust in settlement, trust in liquidity, trust that claims can be honored under stress. History shows that trust is the first thing to vanish when systems destabilize. There is no universally correct choice, but there is an informed one. Choose intentionally. Part 14. The Great Transfer of Wealth. Every fiat collapse follows the same arc. It doesn't begin with panic. It begins with denial, then distortion, then scarcity, then repricing. And when the transition completes, wealth moves predictably. From paper, tangible from promises, assets from confidence, scarcity. This isn't new. It's cyclical. Ancient Rome, Weimar Germany, Argentina, Lebanon. The pattern never changes. What is different this time is the scale. Never before has the global financial system been so leveraged. Never before has debt been so widespread. Never before has trust rested so heavily on abstraction. If 2026 unfolds as expected, it may represent the largest transfer of wealth in modern financial history, not through violence, but through repricing, quietly, relentlessly, mathematically. Part 15, the final warning. We are in the final phase of cheap silver, not because of speculation, not because of hype, but because of physics. Once physical demand overwhelms available supply completely, price becomes secondary. Availability becomes the constraint. You cannot hedge what cannot be sourced. You cannot buy what does not exist. And you cannot rewind a market once inventories are gone. This is how asymmetric trades end, not with a warning, with absence. Conclusion. The age of paper is ending. Silver at $150 is not radical. It is rational. The dollar is eroding slowly. Supply buffers are gone. Industrial demand is locked in. Confidence in paper settlement is thinning. This is not a theory. It is consequence. Markets don't negotiate with reality. They adjust to it. And when physical truth finally asserts itself, price is no longer a discussion. It is a verdict. If this analysis helped you see what others are missing, like the video, share it, subscribe, because this story is unfolding in real time. And when the system finally admits the truth, it won't wait for permission.